it's looking pretty grim when it comes to the global picture. You have US futures that are seeing a sharp downtick. In fact, you have also Apple stock that's actually seen a downtick about 10.8%. That's the Apple Frankfurt listed stock that's seeing a downtick, because you have Warren Buffett, who's actually cut stake in Apple. But not just that, you had the Japan market actually see a downtick of about 12%, intraday 13%. Topics is down, Kospi is down and out. US futures are down and out. And what do we make of this global sell-off coming in? We have Nikunj Dalmia also joining in. And Nikunj, everyone is trying to understand what exactly has happened over the weekend. There are multiple factors impacting the markets right now, isn't it? There's not just one thing that you can watch out for.
Even I'm surprised with the brutality of the fall. I mean, everybody, I'm sure, is surprised with the brutality of this kind of a fall, because frankly, there's nothing that scary which has changed over the weekend. At least that's my limited understanding. It's a risk-on moment which is getting multiplied by what is happening in Middle East. Yen carry trade is reversing. Buffett's exited out of Apple. And then there is fear of a recession. The same market had ignored all fear of recession. The same market had ignored when yields went to 4.4%. The same market had ignored when there was a real fight-like in situation, or when geopolitical tensions actually happened in the Middle East. So I think it's the weight of the market which equity as an asset class, I think, is now finding it difficult to digest. I always say that markets, they rally because of micros and they start reversing because of macros. And I don't think macros have changed that much that you can say the bull market in a sense has ended. Charu Chanan joins us, global strategist, head of fixed. He's not there? Oh, Charu's there and Manpreet, they both are there. All right. Charu and Manpreet, good to have both of you. Thank you for joining us. Manpreet, what has changed in the last 48 hours that it appears like a sell-off we've seen in and around COVID crisis, or what we've seen in 2008? I mean, the screen smacks of bloodbath, while the news is not that bad.
No, I agree with you. I think we need to separate the short-term volatility from the big picture fundamental, right? In my view, there are two factors that are driving this. On the fundamental side, the concern obviously started in the US after we had the release of much weaker than expected job market data, because that really caused a little bit of a reassessment, of the soft landing thesis, or whether downside risk to growth were greater than what the market was pricing. And I think that helped explain particularly what we saw on US yields. But when you think about the second factor, I think is really what we're seeing in Japan, because we had the Bank of Japan going the opposite direction. And from the Japanese yen, the extent of strength we've seen, I mean, the yen is up well over 10% just within this month. And I think that helps explain a lot of volatility we're seeing in equity markets around the world, particularly with US tech, because we know that's being a big source of global liquidity, of the carry trade, so to speak. And I think that in the near term seems to explain a lot of what we're seeing on the equity side, much more so, rather than, like you said, a big sort of reassessment of fundamentals. I think what we really need to see is the dust settle a little bit on the position unwind, the excessive positioning unwinding in the Japanese yen, in US tech, before we start sort of taking a fresher look at whether fundamentals have changed or indeed we're still in the same place.
Okay. Charu, what is your sense? What is calling this selling?
No, absolutely. I agree with what both of you just said. Nikunj, it's been a dramatic shift in sentiment caused by, of course, that one jobs report out of the US on Friday, but coming at a very critical time when, like Manpreet also said, we've had some signs of the carry trade unwinding because of a hawkish pivot from the Bank of Japan last week. And along with that, there have been these other smaller drivers, I would say, something like Warren Buffett taking down some of his positions. There's been some amount of disappointment around tech earnings as well, particularly what happened with Amazon last week, and very, very importantly, what happened with Intel as well. So there have been some big drawdowns there that has obviously hurt the sentiment as well. But overall, I mean, I certainly think that this is kind of an overreaction to one jobs report. You can't go from worrying about elevated inflation to worrying about a dramatic recession in 1 week. So I think certainly there's going to be a reality check. There's a lot more important US data coming out, particularly today, the ISM services number, and then going on in the week as well, which will give us a reality check on really how bad is the US economy faring and whether we should really be expecting the Federal Reserve to cut rates by 50 basis points in just one meeting in September, or over 100 basis points through to the end of the year.
Charu, if this is a sell-off which is largely because of technical factors and this is not a macro event, do you think this will be remembered as a bull market correction that by the time it hits you and by the time you realize it will be over?
Yeah, it could be very well be that, right? I mean, an August sell-off or a correction, because we already know that US equity markets have traded to very high valuation levels. There's been huge amount of concentration risks, which we've continued to, warrant the fact that that needs a correction, really. And, obviously, taking some of that risk off the table after climbing to such highs, it deserves a correction, right? And it could, in the end, prove to be a healthier correction, but we really need to watch how the US economy fares. I mean, it has been a bit of a two-lane economy, I would say, where some parts of the economy continue to be resilient, but there are other sectors that are getting hurt because of those high interest rates. And there's no denying the fact that the US labor market is loosening. But again, I would emphasize, coming from a point where we've been calling that the US labor market is loosening at a very measured pace, to today suddenly saying that the SAM rule has been triggered, and this is a very key recession indicator, and we need to brace ourselves for something worse. I think that looks a little bit premature at this stage.
I can understand that there is a sharp sell-off in leverage. There is a sharp reversal which is happening in currency or commodities, but the selling is very unique and very widespread. Gold is down, Bitcoin is down, currencies are down, 10-year paper is down, everything is down.
And look, maybe on that point, I can jump in a little bit, right? Because I think the linkage here is quite important. You're right, a lot of things are down, but if you think about what's down, the theme is quite consistent. It's been the popular trades, which is US technology, obviously cryptocurrencies fitting into that, and a lot of these link back to yen funded trades, which in every cycle we know, at least the last few cycles, that's been a big source of leverage. But I think here's where a little bit of hindsight almost is helpful. I was looking at what we'd published ourselves just a couple of days before the sell-off on Friday, and what was causing us the most concern going into last week was positioning. And that was excessive positioning in the yen, excessive positioning in US markets, particularly the tech sector. And I think with that benefit of hindsight, which is always nice to look at after the fact, that's where we've seen a lot of the pullback, the current sell-off being concentrated. If I look at US sectors more broadly, though, I think within sectors you're seeing quite a bit of dispersion. So I think that's one factor that argues that this sell-off is quite linked to that carry trade area. The second is, even if you look at the extent to which the VIX has jumped, the extent to which the dollar's weakened, we are so far within ranges we've been in the last 12 to 18 months. So there are rises in volatility, but not at the scale of recessionary sell-offs. So that's why I think, I suppose I'm agreeing with Charu to a large extent that, look, what we seem to be experiencing at the moment seems to be more positioning-led and unwind what was very excessive positioning. And these are hard to time when exactly they'll bottom. We can look at technical levels, but momentum is quite strong. What's important is once the dust settles, to get a handle on, US labor market weakness for us is really the big fundamental risk. Perhaps we haven't weakened, quite as much as markets are fearing, but that's to me the key one to keep an eye on from a fundamental perspective. What's happening right now seems more positioning led.
Okay. Charu, today it's looking like a sell-off. Soon when asset deflation starts, it may look bad, and then it will start having impact on the way how currency, carry trades, a lot of interconnected things would move. What are the chances that what looks like a spark right now, it could just be a beginning of a difficult fire, so to speak?
No, I mean, I would agree there might be room for this unwinding to run because, again, the key point here being what Manpreet just said, because we have had massive skewed positioning in these trades. But when I speak from a structural lens, Nikunj, you talk about inflation from a structural perspective, you still have a US economy that continues to and will continue to spend massively. You still have a green transformation that continues to call for a higher structural inflation. You still have risks of trade tariffs playing a part there. So a lot of factors really pointing to the fact that to expect inflation to come back down to 2% looks like a little bit of a stretch at this point. And when you say that, then it also gives you some sense of where yields will go. Can yields really go back to the lows that we've been used to seeing just before this latest hiking cycle? And if you think that is not going to be the case, then to me, very much it sounds like the fact that these yield differentials are here to stay for quite a substantial period of time. If the US yields are going to be above 2.5%, 3% or so, the Bank of Japan can do only as much in closing that yield gap that it has to the US yields with its small paced rate hikes, even a 15 basis points rate hike, what it's doing to the Japanese stock markets, it's pretty evident at this point, and how far they can go from here remains a big question to me. So in a sense, I mean, of course, volatility, I think that is the key driver here. And if we see volatility staying low, then I don't see why carry trades will be unwound in a massive, massive manner here.
Charu, where does India fit in? We've fallen the least. We're the best story right now. Do you think in this entire global carnage, India will fall, but it will fall the least?
So if you talk from an FX lens, I certainly see that the INR is getting hurt today because that is, again, one of the favorite target for carry, especially in Asia, and especially after the elections have been over. INR has been pretty stable, and that obviously gives it room to be a favorite destination for carry trades, which, again, like I said, right, there could be some risk of an unwound, tactically speaking, in that space. But from an equity lens, certainly India looks like a safe haven in this space. The only headwind that India could face is how much China can provide stimulus, a demand-based stimulus, because that's where they're shifting their focus to, from supply-side reforms to demand side stimulus announcements. And if that kind of really picks up from here, we see Trump trades unwounding as well, and the potential of Kamala Harris coming through as the next US president. We could have some flows diverted to China, which is far more undervalued compared to India at this point. But again, structurally speaking, India looks like a better safe haven in this whole global rout that we are facing right now.
All right, Charu and Manpreet, thank you very much. It's a day when you just want to sit back and say, I will do nothing, because you never put money on the first fall. And I'd just like to remind our viewers that last two local events, if you bought the fall, it's been a rewarding experience, which is that, let's say you bought the market on the day when markets fell on the election day, or you bought the markets on the day when elections fell on the budget day. When the news was not something what markets were expecting and you bought the fall, you were handsomely rewarded. But this market, when I say this market, Indian markets were due for a correction. Correction comes and knocks you, you don't know when and how. But what do? Do you go out and buy? Well, you don't go and buy this first correction, because this is a global correction. And typically when the global correction of this magnitude comes, it's not going to settle down in a day or so. And rather than being a compulsive buyer on decline, I would say it's better for the trend to settle down rather than just jumping on the first flash, because recency bias is something which we all suffer with, and the recency bias of what happened on the election day, 5th of July, what happened 5th of June, what happened to the market on 23rd of July on the budget day when you bought the market fall, I think is something which tends to have an impact on India. But you were due for a fall, global markets were due for a fall. When it hurts, when it hits, it will hurt you. And today I think a lot of portfolio repositioning will happen. The VIX has gone up 50%, and typically when VIX goes up in such an elevated manner, those are not the times when you buy. You buy something when there is either outright value, or there is sign of a reversal, or there is reasonable amount of conviction. Now, where do I have reasonable amount of conviction? Here's where I have reasonable amount of conviction, Cheryl. My reasonable amount of conviction is coming from the fact that Indian corporates are not leveraged. So even if interest rates and carry trades reverse, it's not going to have an asset shock like 2008 when corporates were leveraged. That's the first thing you need to look at a global sell-off. Second, the macros in India are getting better. Interest rates are coming down. And the positioning of the bond market is also such that I don't think there is a problem in terms of a macro reversal. Third, there is a lot of support which is coming from SIP investors. They're not going to go away in a hurry. Fourth, we are still in an economy which is growing. The risk is valuation, risk is not growth. This kind of an asset sell-off, I think this is more like unwinding rather than event based. Typically markets, they peak out when there is event or when there is a huge risk of valuations. So this extraordinary run up, I think in equity as an asset class is getting checked. We will get hit, but if others are getting hit, we will get scratched. That's my limited.
That's exactly the way how the markets are looking like at this point in time. Thank you so much, Nikunj, for joining us on the show as well, for giving us your take to explaining it to our viewers and also breaking it down for our viewers as to what should you do in this sort of a fall right now. Just hold tight, sit tight, don't do anything. This is just could be one of the early signs of a correction in the global markets. For now, you have Nifty that is trying to hold on to that 24,000 mark. On that